When people first get into financial markets, they focus on very specific things. Whatever they're putting money into, they look at those things and they just pretty much disregard everything else. You'll find that this is an epic mistake and it will cost you a tremendous amount of money. Having been inside financial markets for nearly 4 decades, I can tell you the Tier 1 charts are the charts to look at. Specifically, we're going to look at the DXY and Bitcoin, the US 10-year yield and total crypto market cap, as well as the S&P 500. I'm going to give you an insight into whatever you're looking at. For example, if you were looking at Microsoft or ADA or Doge or Solana or Tesla or Apple, whatever those things are, if you look at what I'm going to go through now, you'll have an insight into the markets that you would generally take decades to develop otherwise. Before we get into this video, let's just do a quick synchronization in with the markets. You'll find that synchronization is wildly important as well, but that's a topic for another video. Hi everyone, I'm Ken from CryptoTradingKS. If you're new, a very warm welcome and welcome back CTKS family. Here you'll learn how to become fearless in financial markets to assist you to become more of a financial and emotional blessing to yourself and those you love. If you like the content, please subscribe to the channel and smash that like button. All indicators that I use in the daily videos come from the service at ctksmethod.org. Let's run the numbers. I love to demystify financial markets for you. If we think about the engine of financial markets globally, just think about the average car. It has 30,000 parts. If we were to strip back all of those parts, we'd get a bit of a mess, but you can understand that cars are complex, financial markets even more so. If you're a motor mechanic, you understand car engine parts really well. But if you gave the average person who wasn't a car mechanic all of these pieces and said, put this thing together, the first thing that they would probably say is, what the heck is it? Well, it's an engine. Ken, what are you talking about engines for and cars? We just want to understand financial markets. Well, if you think about a car has more than 30,000 parts in it and they're all moving around. If you just looked at the chair in your car and said, this is my car, well, that's a little strange, isn't it? Because that's not your car, that's just part of it. Or what about if you dove into the engine and said, oh, this is my engine, and you just looked at one part of it? That also really wouldn't work. If you want to drive your car, you need to put the pieces together. What I'm trying to help you to see, when you look at the Tier 1, Tier 2, and Tier 3 charts, you have to be aware that the Tier 1 are the most important to look at initially. They're like the engine of your car, but you know your engine, and that's just part of the parts of a car. Putting the whole car together is the important thing for us to do, but at the moment we're just looking at the engine of financial markets globally, those Tier 1s, and I want to show you how to read them. The first thing is to understand that all financial markets have rules. All markets are intercorrelated and interdependent. This just means it's just like a car. All those parts are intercorrelated and interdependent too. Understanding how markets work is incredibly important. We have what are called high-impact economic data releases. They impact Forex yields and bonds. Yields, bonds, and Forex impact commodities such as gold, silver, and oil. Government policy is a very important thing to keep your eye on. Often people just can't figure out why the stock market and crypto move in certain directions. That's mainly because of this area here, the Forex yields and bonds. When we look at the Tier 1, Tier 2, and Tier 3 charts, what we're effectively doing is looking at how markets can move. This is pretty abstract at the current time. But the idea is, if you just look at one specific chart, you're just like honing in on the steering wheel of a car. Or if you look at something else, that might be a gasket or an exhaust pipe or something like that. Just keep in mind that all of these little parts just merge together to form the vehicle that moves you around. There are a lot of different parts inside different makes and models of car. When we look at a motor vehicle, we just look at something like this and say, well, where's the steering wheel, where's the seat, and where's the accelerator and the brake? That's cool for me. You just want to drive the thing. But if you look into the engine, it's a completely different perspective. Knowing that cars have around 30,000 parts in them is pretty interesting by its own right. And financial markets are incredibly complex. They have a lot of moving parts too. In this video, I'm going to explain some of the most important major components, especially inside the Tier 1 charts, that you must understand. If you don't understand these components that I'm going to talk about, it's like you just focusing on a wheel or focusing on a seat or focusing on some other component and not realizing you need to know where the car is heading and if the car is in working order or not. To start the ball rolling, I'm going to look at the US 10-year yield. The US 10-year yield has been around since 1912. That's in excess of 40,500 days worth of data. But when we look at the US 10-year yield, which you can say, that's kind of akin to mortgage rates. What we can see recently is the US 10-year yield spiked, came down, spiked again, and is coming down. It's trying to decide if it goes up or if it goes down. A lot of people would say, Ken, I don't really care about the US 10-year yield. Who gives a hoot? I'm only in crypto, or I'm only in Forex, or I'm only in gold and silver commodities, or I'm only in the stock market. I just need to look at the steering wheel, and that's enough to drive the car. Of financial markets, as you're probably figuring out, it's not enough. Let's have a look at total crypto market cap, which has been around since 2014, nearly 4,000 days worth of data. But going back to the US 10-year, we saw it go up, we saw it go down, up and down, and now it's trying to figure out where it's going. And we can see a little bit of negative price momentum. When we look at total crypto market cap, which is effectively like the S&P 500, but for the crypto market. Well, it's kind of a little bit more than that. It's the S&P 500, the NASDAQ, the Dow, and the Russell all merged in as one major indice. Now you might say, Ken, there's no relationship. Look at this. It went up and down and went all over the place. What is the 10-year got to do with total crypto market cap? I'm glad you asked the question. If we invert this scale, what do we see as the US 10-year went up, which means the inversion of the US 10-year came down? What did total crypto market cap do? Oh, it came down with it. And as the inverted US 10-year went up, what did crypto do? Oh, okay, it went up. And then we have some wavering around, but we can see on average, this price path is being followed. Now, what does it mean for crypto now? If the US 10-year yield continues to degrade, we would expect the total crypto market cap, that is like the S&P 500 for crypto, we would expect it to go up if this momentum is maintained. But Ken, I want to look at Bitcoin. No problem. Here we go. The US 10-year yield going up, going down, going up, going down, and just mucking around right here. And we can see this is the normal US 10-year yield. How can we tell it's normal? The low values down here go up to higher values in here. What does this mean? This curve is non-inverted, but I'm going to invert it in a minute so we can have a look at Bitcoin more effectively. What was happening when the 10-year was going up? Oh, Bitcoin was coming down. In fact, this is pretty interesting. Is this an inversion as well? Let's check it out. When we invert the US 10-year yield, the inversion is a really good predictor of where Bitcoin is going. And if the US 10-year yield continues to degrade, that is, if the inversion continues to go up, we would expect Bitcoin's price to go up with it. The stock market is a little bit more relaxed than crypto. Crypto trades 24 hours a day, but when we look at the S&P 500, which has been trading for over 55,500 days, what can we see here as the US 10-year went up? What was the S&P 500 doing? Well, let's invert this to give us a better concept. We can see the inverted US 10-year gives us some pretty interesting concepts on where price can go. One thing that we're seeing, as the US 10-year yield starts to break down, we would expect upward momentum inside the stock market as well as crypto. And this is going to translate through to gold, silver, and commodities. What about when we look at the DXY? The DXY is vitally important to understand. And a lot of people say, oh, Ken, I'm not in Forex. I don't care about such things. Oh, you should. You should care very, very much. Let's have a look at the US 10-year and the DXY. What do we see here? That's quite a relationship. And the DXY is currently breaking down. Ooh, what does this mean? Let's pop back to total crypto market cap. Now, what do we see here? I've just overlaid the DXY and the US 10-year yield. We can see that from an inverted perspective, the inverted DXY and the inverted 10-year are giving us a fairly good indication as to where total crypto market. Just think of the total crypto market cap indicator is literally like the major market index of the crypto market. And what is it telling us right now? Well, I think it's telling us a very good story. It's trying to break up and break out of this resistance. Ken, what resistance are you talking about? When we look at the Tier 1 charts, the Tier 2 charts, and the Tier 3 charts, and we're just focusing in on the Tier 1s at the moment, what are we specifically looking at? We've looked at the DXY and Bitcoin. We've also looked at the US 10-year yield and total. You're probably starting to get an idea of how important these are. We also took a peep at the S&P 500. What we've been examining is what is called directional correlation. But that's not enough. That's the baby step to get you through the front door. But the real issue is the structure. If we understand what the structure is, we can tell if a price is reversing or it's continuing. Returning to total crypto market cap, and just view total crypto market cap as like the S&P 500, but for the crypto market. When you look at this, you might say, oh, there's a resistance in here, and there's a resistance through there, and that becomes support, and oh, there's resistance here. But this is not the way to do it, because we're literally dealing with nearly 4,000 days worth of data. There is a statistically significant way to do it. And that is simply to apply the CTKS method to your charts, which you can mark up yourself. But if you don't want to mark up the chart, you can just pop on the indicator, and I share these levels as well. Remember how we were saying, oh, there's a level of resistance here. That's a recent indicative price, or RIP level. When we look at statistically significant levels, we can see those playing out here. Statistically significant are exactly that. The whole of finance, the financial world, is based off statistics. It's based from mathematics. It's a very important thing to understand. Statistically significant means that the price will obey them. Price obeying structural levels is very important to understand. What do we know now? We know that the DXY and the US 10-year yield are starting to decay. What does this mean for crypto? We're starting to see that the positive price path could be followed for total crypto market cap. Now, what does this mean for the seats, the steering wheel, all those accessories inside the car, as well as the exhaust and all the other car components? For example, in financial markets, if you are in the crypto market, expect your alts to go up if the DXY and the US 10-year yield come down. There's something really interesting. When it comes to structural lines, they're far, far different from any other line that you will encounter. We can see structural support at 1.608 trillion, but the next structural resistance line is all the way up here at $1.637 trillion. That means that we're getting into a positive fresh air gap. Crypto, if we see the DXY and the US 10 continue to decline in value, crypto could just surge up. This is very good news for us to know, and it's another reason why you need to know where structural levels are. What about when it comes to Bitcoin? We can see a structural support area at $43,044 and a structural resistance at 43,209. Bitcoin is currently 43,139. Inside financial markets, it's a very straightforward thing to understand where price is going. So long as you know where the structural levels are, and you can see there's more than one of them. The structure is what smart money looks at. We're in a very specific situation. If we break up out of this 43,200 resistance level, we're going to make our way up to the 43,845 level. But if we break down, and how do we break down? What's the mechanics of that? And I use mechanics in a very specific terminology. It's like the car engine. We have to look at the components. The mechanics of a breakdown towards this structural support level at 41,970 would be a spike in the DXY, a spike in the US 10-year, and that's just scratching the surface. Something very important to comprehend. Structure always overrides. If you have structural levels, they will always override directional correlation. This is one thing that you must be aware of. Structure is everything inside financial markets. And the CTKS method is the world's most powerful structural level detection system. Directional correlation will only take you so far. You can look at this as the US 10-year and the DXY have been retracing in terms of value. But this is not enough. If you don't know where the structure is, you don't know where the fresh air gaps are to the upside and to the downside, you'll be in a lot of trouble. Structural levels are the most powerful things that you can ever place on your charts. Hopefully, this very brief introduction to the Tier 1 charts, in terms not just of their directional correlation, but also in terms of structural levels, will help you significantly. And just an update for the CTKS Method monthly member service, all the Tier 1 and Tier 2 charts are now being released. Each month inside the service, I release the CTKS Method paths. What these paths are designed to do is to help provide a context where price might end up at the end of the month. Sometimes they're fairly good at doing that, and often you won't see an exceeding of the boundary from the upper to the lower limit. And when we're looking at exponentially increasing prices, that's not a bad effort, but this is all done with a knowledge of CTKS structural levels. Those dotted lines are called Stanfield levels or SLs. This particular price structure is always drawn up with SLs in mind, so something to be aware of. Those paths are inside videos inside the service, and if you would like to see where Bitcoin could end up at the end of the month, like we've looked at for the last couple of months, you can see that inside the service, as well as all the Tier 1, the other Tier 1 and Tier 2 charts. You can see it's very helpful to know where price could be going from a positive perspective and a negative perspective. We've seen so far that Bitcoin has held the consolidation and then rallied, just midway between the positive and consolidation case. And then we saw it rally again. But the interesting thing is these are normalized price paths. What that means is that even though price can fluctuate very wildly at the start of the month, it typically comes back to where that normalized price path would end up. This is very important to understand. And we can see last month we finished on a consolidation case. We did have the capability to go to the positive case, but there was substantial structural overhead resistance and the yields in DXY spiked up, causing Bitcoin to decay. And of course, there were other in-market issues as well. People unfortunately make the mistake of not looking far enough when it comes to financial markets. They may look at one thing or they may just look at what they're trading and investing in. But if you don't look at how the market's health is moving, if you don't seek confirmation from the Tier 2 and Tier 3 charts, it's like driving with a windscreen that you can't see through. Another way that you could look at it, when you're driving the car of financial markets, your instrumentation panel are your Tier 1, Tier 2, and Tier 3 charts. They'll tell you how fast you're going, if you're about to fall off a cliff, or you're about to encounter a fantastic piece of scenery. In this video, we literally just touch very quickly on the S&P 500, the DXY, and Bitcoin, the US 10-year, and total, but there's many more associations. And in each month, I bring out these associations across the different Tier 1, Tier 2, and Tier 3 charts inside the service. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.